Tamakaze here, talking about a swing strategy that you can use to lock in profits and save yourself a whole bunch of headaches. So I've highlighted a strategy here to try to make it as simple as possible using Apple from the last 7 days. I've highlighted ideally what your entries and exits would be, realistically what you could have expected based on momentum and trends. So I've highlighted this. I'll share this infographic as well as a downloadable, but the strategy is very simple. So ideally, when you're looking to enter a position, let's say this was our first entry. So all these greens are our entries and all the reds are our exits, as if you were to play it every day as a day trade. And we'll go into the strategy a little bit after it. But ideally, what you'd be doing is on the green line, you would be opening up your first position. So this is our first position on December 30th. And so we buy a call option at least 3 weeks out. So for this instance, I highlighted the January 22nd call, and that's the purple line here. And you want to go in the money at least a couple of strikes. So what I did to highlight this was I went back and I looked at the most recent lowest I think it would go to. That would be below this gap here, and this is where our supply zone is. So I chose the 128 for this example. And so I bought a 128 call here. And then if you're being a trader trading momentum, you would have seen that this uptrend would have failed here. So then yet at this point, you would have sold the call option right above the one you had to lock in the gains. So you would have secured a 134 to 135 move, about $1. You would have made about $100 on that if you had bought one purchase. So then you would have sold the 129, and now you hold a spread from 128 to 129. And you would just hold that to the end of the day, and the next day you would continue holding that until you decided that you wanted to play this position again. And at that point, when this downtrend broke the next day, you could then buy back this call, the 129. So now you're holding a naked 128 again to play this momentum up here. And then you could resell the 129 at this position, or you could resell the 130 if you decided that you wanted a little bit more risk on your spread. Either way, what you're doing is you're locking your gains in. So if it goes back down, both of these are going down. So you may be losing money on your call, but you're gaining money on the call that you sold. So you're locking in your profits, so that way you're not losing anymore. You may lose a little bit, and you still have some gains that you can make, but because you're in the money, the fluctuation of what you lose and gain would not be much. And then you could ride this all the way down here and then buy back your 129 for almost pennies on the dollar. And so then on this green line, you're buying back this one that you sold up here, and then you're reselling it at the end of the day here to lock in the gains for the day. And you're basically just doing this over and over on entries where you'd normally buy a call. Instead of buying a new call, you're just buying back the leg that you sold. And so I just highlighted some positions here where I would have figured I would have bought and sold. So I would have bought on all the green lines. This is where I would want to either buy back my previous sold call at the 129 strike, or potentially this is maybe where I would have entered into a new trade. And then by this Friday, I would be entering into 2 weeks to the expiration. So then that's where theta starts to accelerate. So then I would have completely closed it out here, and I would have closed my position probably tomorrow when this would be opening. And then maybe if you wanted to play it again, then you just move the expiration on a few more weeks and you could start over. So I'll just go through these rules. We'll kick golden rules. Always go at least one strike in the money, if not more. I would suggest going in as far as you can to reduce the premium, or reduce the premium that you paid. And then always give yourself at least 3 weeks. If you can give yourself more, it just allows you to do more with the strategy. And then a couple things here. Strategy, like I said, is to buy the naked option to start the position, sell an option at least one strike above yours to lock in gains at the end of the day, or when at the position of the day where you think you're going to get the max profit. And the next day you can buy it back on the lowest point of the day if you're good at it. You can even buy it back at the beginning of the day if you wish, but sometimes you want to wait for the entries to see how it plays out. And then just keep doing that until you want to stop playing the position. And you can do that as long as you want. Reason to use this strategy specifically is it doesn't require using any day trades. It protects yourself from exposure overnight, so these gap downs overnight, you don't get dinged on. You do get a little dinged if you go overnight and it gaps up, but that's part of the risk is that you're trying to play the intraday trades. You don't care so much overnight. The other nice thing is you can play this multiple times and capture the best gains that way. So the other thing that you can notice is if you this ideally what you'd want to be doing on an uptrend like this, but I just wanted to go on the last 7 days what you could do potentially to protect yourself. So going on an uptrend, you're capturing all these intraday moves and you're good to go. So I hope this helped. I'll share this infographic in this video after, and if you have any questions, just let me know.